This is Mark Sobel, U.S. Chair, OMFIF. Today, OMFIF and the Bretton Woods Committee are jointly hosting today's discussion with Bill Dudley. As everybody knows, Bill had a distinguished career as a leading private economist, as the New York Fed's market desk head, and then serving as its president. He's now at Princeton. He's chair of the Bretton Woods Advisory Committee, of which I'm a member. He is one of America's foremost and preeminent monetary policy analysts and commentators. I'm going to pose some questions to Bill on yesterday's FOMC outcome to get his views on the table. We are then going to be joined by Ellen Mead to kick off the audience discussion. Ellen was senior advisor in the Division of Monetary Affairs and a special advisor to Board Vice Chair Rich Clarida before leaving the Fed after a distinguished career there in 2021. I'm going to then turn to the audience, which can submit questions. I'm going to do my best to get to all of the audience questions, but let's kick it off. Welcome, Bill. Welcome, Ellen. Thanks for joining us. So, Bill, before we dig in, what's your top line reaction to the FOMC outcome? A week ago, we were basically all trained to believe a 50 basis point hike was a foregone conclusion. We got 75 basis points in a rapid pivot after a bad CPI print. What do you think about the pivot? Did it surprise you? Was there anything in the statement or Powell's press conference that jumped out at you? And we'll get to the dot plot next. So the floor is yours, Bill. Thank you.
Yeah, I was a little surprised by the move to 75 from 50 because, the data was a little bit disturbing, but, the Fed up to then had been relying on forward guidance, in terms of where the federal funds rate is going to end up as opposed to exactly how fast we get there. So it was a bit of a switch. Now we're focused not just on the terminal level, but also the rate of change. So that's different. And so that's a little bit of a surprise to me that they would make that switch. But at the end of the day, I think it was done for a very obvious reason. The Federal Reserve was worried about their credibility if they didn't respond to a bad set of information. As Chair Powell made clear in the press conference yesterday, they were concerned by a number of things. Number one, the CPI was a bad report. And number two, inflation expectations, some measures of inflation expectations, like the University of Michigan consumer survey that came out last week, was also on the high side. It moved up pretty sharply. The long-term inflation expectation went from 3.0 to 3.3. And so I think the Fed's thinking was that, if inflation looks like it's going to stay higher for longer because the supply chain disruptions are continuing. The Ukraine-Russian war is contributing to that. And so there was a risk that if the inflation stays higher for longer, that inflation expectations could become more unanchored than they have up to now. And so I think the Federal Reserve basically felt it makes sense to take out a little insurance against this, make it clear, underscore our commitment to getting inflation back to 2%. One way to do that is course correct when the information is not as good as what we'd hoped for. So end of the day, I don't think it's a big deal. I think more significant to me is just how much the forecast has changed from March. The Federal Reserve now shows a much higher peak in the federal funds rate, a peak of 3.8% is the median projection for 2023. They show much slower economic growth, running around potential growth rate for the next 3 years. And they actually finally show a rise in the unemployment rate. I mean, before, a lot of people were quite dismissive of their forecast. The Economist magazine called it the immaculate disinflation because inflation came down without the Fed really making monetary policy tight or pushing up the unemployment rate. At least now the Fed is showing a potentially somewhat restrictive monetary policy, some rise in the unemployment rate. And so at least you can, create you can understand now why it's possible that they could achieve this particular forecast. But it's still a very optimistic forecast. It's still a very optimistic forecast because inflation comes down a lot, even though monetary policy is not made that tight. And even though the unemployment rate only really basically gets back to the level that the Fed views as consistent with 2% inflation. And my own personal view is that if you're going to get inflation down back to 2%, you're probably going to have to push the unemployment rate above the rate consistent with 2% inflation, because that excess slack in the labor market is the mechanism that pushes the inflation rate downward. But it's better. So I think they've gone from terribly unrealistic to marginally plausible in their current forecast.
Okay, well, you've anticipated and gone through my question on the SCP. Just one observation: it must be difficult to deal with questions about your credibility when much of the inflation is being driven by exogenous forces that have little to do with monetary policy. Um, uh, you already commented that unemployment may need to rise further. You said it's plausible, but I think I hear you saying you may feel that they have farther to go. So they did push the Fed funds rate above the so-called neutral rate. Um, many are saying that a recession is inevitable. Others are arguing that the chances for a soft or softish landing are slim. Um, do you have a view on how high you think the Fed funds rate needs to go? And do you think a recession is likely?
I have a view, but I don't have a lot of confidence in that view because the level of the funds rate that's necessary to generate sufficient weakness in the labor market to bring inflation down depends in part on how financial markets react to the increase in the federal funds rate. If the markets are very sensitive to what the Fed's doing, the Fed doesn't have to do as much. If the markets are insensitive to what the Fed's doing, the Fed has to do more. And it's also sensitive to where inflation goes. People talk about the term, the neutral short-term interest rate as being, 2.4%, 2.5% in the latest summary of economic projections, but that's assuming a 2% inflation rate. So if inflation's higher, then the neutral rate has to be higher. And then the question is, what inflation rate do you use? Do you use, looking backward or looking forward? Well, probably looking forward. It's based on what you think inflation is going to be in the future. So it's hard to know exactly what the neutral short-term rate is. And I think Powell sort of said that in his press conference, that we're going to be not just relying on models, we're also going to be looking out the window and seeing what's actually happening to the economy and what's happening to financial conditions. And I think that makes a lot of sense. I think a hard landing is probably pretty likely, just because the inflation is much higher than 2%. And the unemployment rate in the labor market is extraordinarily tight. Claudia Sam has done work showing that every time the unemployment rate has risen by more than 0.5%, the outcome has been a full-blown recession. There are no examples in U.S. economic history of a rise in the unemployment rate up between 0.5% and 2 percentage points. It's either a very modest rise or a full-blown recession. The Fed's basically now showing about 0.5% rise in the unemployment rate in their projections. So that just shows you that it's going to be a very tight squeeze for them at this time. So I think the risk of a hard landing has actually gone up. And part of it's what Jay Powell talked about yesterday, that there's a lot of exogenous factors, external factors to the Fed that are making their job more difficult. The Ukraine-Russia war looks like it's going to go on for a while. That's going to generate upward pressure on food and energy prices it's going to be persistent. So, we like to exclude food and energy, in terms of how we think about, the persistent element of inflation. But if food and energy prices stay elevated for a significant period of time, that can itself start to influence inflation expectations. And energy gets into the prices of a whole bunch of other things that aren't energies, directly. When you think about, goods and services like, airline travel, think about the cost of plastic. All sorts of things get influenced by energy prices, fertilizer costs. So there's a lot of things that are going to go up that aren't energy, that are influenced by higher energy prices. So I think the Fed's got a difficult task ahead of them.
And I guess housing costs are rising as well these days. So with the Fed having pivoted to 75 basis points yesterday, what's your outlook for July and September? Do they have to go to 75 in July? How are they going to communicate all this? Let me stop there right with that.
Well, I think Chair Powell tried to get himself out of the box that he put himself in for this last meeting by saying that the next meeting was going to be 50 basis points or 75 basis points. So they give themselves a little optionality. Now, the interesting question is that as we get closer to that next meeting, do they steer the market to 50 or do they steer the market to 75? Or do they just have the meeting and decide? The other thing I would just say about how this occurred, I would be a little annoyed if I was an FOMC participant, frankly, and had the Fed and had the chairman talk to the markets about it was going to be 75 before I actually had the meeting. You know, in principle, the meeting is to have the discussion about what the Federal Reserve should do. And so if the chairman is basically saying it's going to be 75 before the meeting takes place, you are disenfranchising the other FOMC participants to a degree. Now, that didn't seem to annoy anybody because we only had one dissent. Esther George dissented. Esther is generally has a hawkish view. And I expect why she dissented was not because she disagrees with the notion that the Fed has to make monetary policy tight, but she probably felt that it was a bit of a lurch to not follow through on the 50 basis point rate hike you promised. Because when the Fed changes their mind at the last minute like this does have the potential to undermine the credibility of the Fed's forward guidance. And the Fed, leans on this forward guidance significantly in terms of how it influences financial conditions. If you have confidence about where the federal funds rate is going to be 6 to 12 months from now, that's going to get priced into the bond market today. That's going to be priced into the stock market today. But if you don't have confidence, if you think the Fed is going to do something, could very well do something dramatically different, then forward guidance doesn't work as well. That said, you can't just put monetary policy on autopilot because the data will evolve in ways that are surprising to you. So the Fed has this tension between we want to guide the market so the market can incorporate what we're going to do in the future into current bond and stock prices. But the economy is uncertain, the outlook is uncertain, and so we might have to deviate from that guidance that we've given you. And that's a tension that the Federal Reserve has to wrestle with all the time.
I recently read a book by William Silber about Paul Volcker, and it said that one lesson that Volcker had in the early 1980s was that the Fed in the preceding periods hadn't carried through, hadn't stuck with its inflation fighting course long enough. Any concerns the Fed might ease off prematurely? And since there's been a lot of discussion about this lately here and there, are we looking at the 70s?
Well, I think Jay Powell is very aware of what happened in the 60s and 70s and how Paul Volcker had to do something pretty extraordinary to get the inflation expectations back down and break the back of inflation. He doesn't want to end up in that place. And the way you don't end up in that place is you prevent inflation expectations from becoming unanchored in the first place. You basically do what you need to do so that the genie doesn't get out of the bottle. So I think he's going to do that. I do think he's going to do that. I wish he would, though, be a little bit more forthcoming about the pain that this potentially might involve. At least at this meeting, he talked about policy being restrictive. The last press conferences, he has not even been willing to say the word restrictive. So we're moving in the right direction, that the policy will have to be restrictive. But he's still very cautious about talking about, what this actually is going to mean for the unemployment rate, what's going to mean for job seekers. The reality is the labor market is too tight to be consistent with 2% inflation. It needs to be looser. And unfortunately, that means that the unemployment rate is going to have to rise. That's in the Fed's forecast. But the chairman has been pretty reluctant to be, as blunt about it as I just was. And I understand that. I mean, it's not a pleasant political message, but this is where we are. The labor market essentially overshot. And I think it's better to recognize that and say it early rather than have it only become evident over time. Because if it only becomes evident over time, then people will say, well, you didn't really tell us what was really going to happen. It turned out to be more painful than you implied. And if that's how it goes, then that could actually be harmful to the Fed's credibility going forward.
And of course, as you were suggesting earlier, the dot plot shows the long-term unemployment rate basically going back to in line with what many think is neighbor. Balance sheet reduction has begun. Recent Fed work shows that a $2.5 trillion balance sheet reduction would be equivalent to a 50 basis point hike in the federal funds rate. How do you see QT interacting with rate strategy, the treasury market, and overall financial conditions?
Well, I take a very out of consensus view on this because people basically say, well, the balance sheet's coming down, therefore the Federal Reserve doesn't have to hike as much. And that's true in the sense that if they didn't bring the balance sheet down, they would have to do more in terms of short-term rates. But where I differ from the consensus on this, the balance sheet still is adding accommodation a day. The balance sheet is very large, and it's going to take 3 years for the Fed to get the balance sheet back to neutral. So if you think of the neutral short-term rate as a rate in the long run that's consistent with, that's dependent on whether the balance sheet is enlarged or normal. Right now, I would argue the neutral rate probably has to be a bit higher than normal because the balance sheet is still very, very large. It's going to take 3 years for the Fed to basically get their balance sheet down to neutral. So the balance sheet is actually still adding accommodation. People don't talk about it that way. They talk about it how, well, shrinking the balance sheet means the Fed's not going to have to do as much. That's true. If they didn't do it, they'd have to do more. But the fact that the balance sheet is so big today means that the neutral rate's probably a little bit higher than what they're writing down.
So you're one who has particularly paid attention to financial market conditions, indices, and whatnot. And after all, the transmission of monetary policy to real activity works through financial conditions. So equities are way down, the dollar's strong, rates have gone much higher. I mean, how do you feel about the current state of financial conditions? And let me just tack on to that then. Do you have financial stability concerns? I hear the treasury market liquidity is very strained. What about that dimension?
So I think the tightening of financial conditions we've seen is a good thing. And I think the Federal Reserve is happy that this has happened. This is the mechanism by which monetary policy exerts its effects on the economy through long-term interest rates, through the stock market, through the dollar, through credit spreads, much more than the level of short-term interest rates. So I think this is actually a welcome development. I think there's a question about how much tighter do financial conditions need to be. People who focus on the change in financial conditions would say that, hey, we've gotten quite a bit of restraint. But if you look at the level of financial conditions, they're still not that tight. We're moving from a very easy set of financial conditions to something that's maybe more closer to neutral right now. So I think it's really the question, is it the change in financial conditions that matters or the level of financial conditions that matters? And the reality is probably both. So my view is it's a good thing that the Fed is finally getting some traction and getting financial conditions tightened. And we'll have to see if this is sufficient or not. The tricky part about the outlook too is, in many sectors, demand exceeds supply. So even if you tighten monetary policy and tighten financial conditions, then you reduce demand, it's not clear it's necessarily going to feed through to the real economy in terms of activity very quickly, because you're just pushing demand down to meet supply. And the auto sector is a great example of this. I talked to an economist at one of the major auto companies a few months ago. I said, how much more cars could you have sold if you could have produced that? And it was in the millions of cars. So the excess demand for autos over the last couple of years has been millions more than what's actually the automakers have been able to produce. So even if we reduce the demand for autos by higher interest rates a bit, auto sales may continue to ramp up as supply disruptions hopefully get solved in the chip sector.
Any comment on any worries, financial stability concerns right now?
Well, whenever markets are moving fast, you always have to worry about the strain that's putting on people who are levered. And I guess I'd be more concerned about what's happening in the cryptocurrency space than I would be in the more normal dollar space, because I do think the reforms that were made following the great financial crisis were important in terms of bolstering banks' capital and liquidity, and improving their governance and risk management. So I think the banking system is fine. I do still worry about the treasury market a bit, just because the size of the treasury market is so large. And the balance sheet capacity of the primary dealer community to step in and absorb sales of treasuries in duress is pretty limited. There have been a number of arguments to reform the treasury market. I think that's something that we should do. I'd love to see, for example, the leverage ratio, exempt reserves from the leverage ratio to give big financial firms more room to come in and buy treasuries in extremis. I think that treasury market reform, I think, is needed because the system by which we distribute treasuries at auction hasn't kept up with the size of the U.S. Treasury market, and it is the most important market in the world. The U.S. Treasury market is a benchmark essentially for all other markets. And if it were to get disrupted, and I'm not saying it's going to be get disrupted, but if it were to be disrupted, it would have lots of consequential effects to other markets. I don't expect that to happen, but it's a risk.
Well, Bill, you've been answering questions so pithily. I'm going to throw one more your way before turning to Ellen. And you just alluded to it. A lot of attention on crypto, stablecoins, central bank digital currencies. I know you're doing work on this. Crypto is well down. Stablecoins recently broke the buck. And the Fed is looking at the need for a central bank digital currency. So do we need a CBDC in America? And what role do you think stablecoins should play in regulation in this area? Simple question. You can answer it in 10 seconds.
Well, I have no problem with stable coins that are appropriately backed, 100% backed by safe assets. The problem is we have stable coins that are backed by other stable coins, and their value is based on what people think they're worth. And if that valuation changes, then those algorithmic stable coins, as we saw in the case of Luna and Terra, just it's totally unstable. We also have cases where people don't disclose what's backing their stable coin, like Tether. That's disturbing, because if someone tells me, if I ask the question, what's backing your currency, and you're not willing to disclose what it is, my conclusion is that's a red flag to me, that maybe the backing is not 100%, and that can create some instability. You could actually develop now a pretty solid stable coin if you actually, if you allowed one of these crypto banks to have a master account at the Federal Reserve and take the deposits and invest them in Federal Reserve reserves, earn interest on those reserves, and then pay, and that would be the mechanism that backs the stable coin. So you'd have one-to-one backing of the reserves for the stable coins, and you'd actually be earning interest now on those reserves. That seems like a much better model for a stable coin than the models that we have today. Where I come out on the whole crypto digital finance space is I'm pretty skeptical of what's going on in stable coins and cryptocurrencies. It seems quite speculative, but I do have a lot of optimism for the technology of blockchain. And I do think that there's a lot of scope for improving the existing financial system, which is very inefficient in a number of ways. Trade finance, cross-border payments, digital identity. These are all things where we could see a dramatic improvement. And at the Bretton Woods Committee, we're doing some work on this and trying to see, what's actually possible. So tomorrow, we're actually publishing our second brief that looks at the positive use cases where this new technology might actually allow us to make significant improvements. We're not saying that these improvements will necessarily occur, but what we'd like to do is run the race. Let the technology have a chance to flourish. Have the regulators lean a little bit more forward. Be willing to say yes occasionally rather than just no, and then see if this technology can actually do things better than the existing legacy technology. Because I think there's a lot of scope for improvement in our financial system. So Bretton Woods Committee, we're going to continue to do a number of the work on this. We have a whole series of papers, 8 briefs in all. The next one will be coming out hopefully in September. They'll be looking at the technology. What can this technology do that the existing legacy technology can't do? And then we'll be diving deeper into things like central bank digital currencies. I think you can have a stable coin that's offered by the private sector and a central bank digital currency. I don't think it's necessarily one or the other. I do think we will have central bank digital currencies. I think the Fed, though, will be a slow follower. I don't think the Fed is going to be, in the lead here. In part because, the dollar is the reserve currency of the world, and you don't want to mess it up. So you probably want to learn from what works in other countries first before you proceed here.
Great. I'm going to turn it over to Ellen. Thank you for joining us, Ellen. And again, I encourage the audience to submit questions. So Ellen, the floor is yours.
Thanks, Mark. It's good to be here. Thanks, Bill, for your very interesting discussion. I find little to disagree with what you said, but I'd like to sort of focus on 4 issues and ask you to offer some comments. So one is I'd like to talk a little more about the surprising pivot that we saw over the weekend to 75 from 50 and what that implies for the committee. I'd like to talk a little bit about yesterday's press conference, about the inflation forecast in the SEP, and about the balance sheet. So first, on this pivot over the weekend, you raised a really interesting point about disenfranchising perhaps other policymakers. And as you know, the chair is both leading the relationship with the external world, but also leading the relationship within a committee. And that's a very important role that the chair plays. And, you spoke about blowing up the forward guidance. Maybe there was another way to do it by just coming into the meeting and coming out with a 75 rather than a 50 and explaining in the press conference, we had to react to the data on Friday and this is what we have to do if we're being nimble. Wouldn't it have been better, though, if you felt you needed to prepare the markets? And I kind of agree with you. I'm not sure why that's absolutely necessary, but rather than run it through the media and then rely on people understanding that this was a signal being sent, and perhaps not every reader of the Wall Street Journal was as able to identify that signal as every other reader. To sort of build consensus over the weekend with your fellow committee members. And then the Fed could have released a press release on Monday saying, 75's on the table at the meeting, in addition to 50. And just a one sentence or something, giving an alert, everybody would have understood what that meant. And that would have been a more egalitarian way of informing the public. So I'm kind of interested in that. And also, what you think about sudden announcements like this, and then a sudden unscheduled meeting of the ECB. Are we in a mode now where central banks are going to be breaking the China from the last 20 to 25 years in terms of predictability of communication? So that's sort of my first issue. My second is around yesterday's press conference. I totally agree with you that it was a more realistic discussion. I think we got hung up a lot since the beginning of this year in the whole question about neutral and where is neutral and what inflation rate you're using to get to nominal neutral. And I did think that in May, the chair did a better job of moving the discussion to financial conditions. But I do think you're right. You have to talk a little more about the pain involved with restrictive policy. And I'm wondering, when you see that happening, do you think in September the SEP could move to showing a mild recession, or is a recession something that they're not really going to want to show until it's sort of right in front of them? And it reminds me that, that Secrets of the Temple, that old book that was written about the Volcker era, suggested that a rationale for switching to reserves targeting, as Volcker did in the operating regime change in 1979, was really to divert attention away from policymakers about how high interest rates would need to go. And I wonder if that is at all informative in terms of thinking about how the Fed navigates forward. And then third, on inflation, the board's inflation forecast that we find out about every time we read the minutes has been very quick to return to 2%. I'm pretty sure that a lot of policymakers at this point think that perhaps that forecast is repeatedly too optimistic, but the board's forecast does form a baseline for people when they're putting together their SEP and so on. And so how much of a role do you think that forecast has played? I know Mohammed Al-Arian, I think earlier this week, called for, sort of throwing over the staff doing the forecast or something like that. But I'm wondering what you think about that and whether you think that the board's forecast has been perhaps unhelpful in this episode. And finally, on the balance sheet, there are just lots of questions here. If the economy does slow, goes into mild recession, deeper recession, what's the likelihood of completing that QT plan that they laid out? Do they pause that in the middle? Do they keep going? Another issue is, 3.5% on the Fed funds rate is estimated to be the sort of break-even rate when expenses equal income, and after that, then the Fed posts a loss or a deferred asset on its balance sheet and stops remittances to Treasury. In this current SEP, we have the 3.5 percentage point being reached sometime next year. How important do you think that issue is? And then does that issue of running losses relate to the discussion on MBS sales? Because MBS sales, of course, you would have to take losses. And I personally, regardless of President Mester's words around needing to be true to the principles, and I think that's right, I think it's very hard for me to see that MBS sales would ever go forward. That seems more realistic to adjust the principles in recognition of that. So I have, of course, many more questions, but I think I've outlined enough probably there to get us started. So thanks.
Okay, thank you very much. Really good set of questions. Well, I think, there's a question of whether you pivot, before the meeting or you pivot at the meeting. There's a question of if you pivot before the meeting, how do you communicate that pivot? I'm sympathetic with where you were coming from. I think it'd be nice to do it in a more, open, egalitarian way. If you read Nick Timros's piece, all he said was they were going to consider 75 basis points. You had to know that was code for consider means do. And I can imagine a lot of people didn't necessarily know that consider means do, or know that the Fed often uses the Wall Street Journal as a means to communicate these kind of shifts. So Fed's become a lot more transparent over the years, as we know, in terms of releasing their forecast, having press conferences, maybe a little more transparency in terms of how you show these shifts in focus are a good idea as well. So I think that's worth considering. I think it's definitely worth considering doing it in a potentially different way. End of the day, is there any great lasting harm from this? Probably not. The interesting question is, did anyone get their feathers unruffled, ruffled by this or not? I don't know that. I don't think it's, at the end of the day, it's a big deal. I mean, if they had done 50 basis points and then you'd come out with sort of a hawkish press conference, you probably would have ended up in about the same place. So I don't think at the end of the day it's that important, frankly. In terms of the press conference, and their projections, I think it's going to be very hard for them to show a mild recession. As you know, the summary of economic projections are based on what you assume to be optimal monetary policy. And if you're presuming that you have the optimal monetary policy, you're probably not going to write down that that's going to lead to a recession. You're probably going to write down that that's going to lead to a soft landing. So I think that, the key to watch will be what happens to the GDP forecast. So right now, the GDP forecast over the next 3 years is basically about trend growth. It's basically the same of what the Fed thinks the economy can grow over the longer run, which I think is 1.8%. So 1.8% is basically, 0.5% growth in the labor force plus maybe 1.25%, 1.5% productivity growth. That's what the Fed thinks the economy can grow over the long run, and that's what they think the economy is going to do over the next 3 years. So that's that. So the Fed's saying the economy is going to grow at potential. I would watch that number. If that number starts to come down, it's a way of implicitly saying that the risk of recession is rising. But I would be surprised if the Fed actually said that we're going to actually have a recession. The recession is going to be, they're definitely going for a soft landing. Chair Powell yesterday said there's still a path, and I think they're going to stick to that story. The only way you go to a different story is if inflation turns out to be much higher for much longer, and inflation expectations get unanchored. In that case, I think it'd be sort of hard to tell a story about how you weren't going to have a recession to get inflation under control. But what the good news right now is inflation expectations, despite all the bad news we've got in inflation over the last year, and the fact the Federal Reserve has been very slow to tighten monetary policy, inflation expectations still are remarkably well anchored, and that's really helping the Federal Reserve out a great bit. In terms of the inflation forecast, in the staff, I think the staff, probably has been a factor here. I mean, I haven't talked to the staff, so I don't, and they're obviously not going to tell me what their forecast has been. I think it'll be interesting in 5 years' time when we actually see the staff forecast to see if the staff forecast about inflation was essentially providing an anchoring for everyone else's forecasts. The way these meetings work is the staff forecast goes out to all the FOMC participants, and then they produce their own summary of economic projections. But the staff forecast, as you know, is sort of an anchor, provides an anchoring mechanism. And so it's very hard for the participant forecast to deviate that much from the staff forecast. So we'll find out in 5 years whether the staff forecast was too optimistic about inflation. I think that's what we probably will find out, but it's going to take a while to actually see that. In terms of the balance sheet, you asked the question, do they junk the quantitative tightening program if the U.S. economy goes into recession? Yeah, probably, if they think that they're going to go back to the zero lower bound for short-term interest rates. I think if they just thought they were going to ease a little bit, I think they would keep the quantitative tightening process going. We saw that the last cycle. The Fed kept the quantitative tightening going all the way until we got to September 2019, despite the fact that there were sort of ups and downs in the economy and changes in the monetary policy outlook. The quantitative tightening just was on autopilot in the background. So I think they'll do that unless they think there's a good chance that they're going back to the zero lower bound for interest rates, because that's really what quantitative easing is all about. It's like when you're at the zero lower bound for interest rates and you don't have any other policy tools to use, you then want to use quantitative easing. And clearly you don't want to be using quantitative tightening at that point, because then there's this tension between quantitative tightening is making monetary policy more restrictive and you're stuck at the zero lower bound. Makes no sense. So I think, it'll be turned off. It could be turned off at some point at that point, but it's the bar to turning it off is really high. It's not just the Fed cutting rates. I think it's more than just a rate cut or two. If the Fed thought they were just taking the funds rate back to neutral, the quantitative tightening would just continue in the background. It's my view. You raised the issue about the Fed taking losses. I think it's, if the forecast that they wrote down yesterday actually is realized, they will lose money in fiscal year in calendar year 2023. You can go back to the Summa Managers report that was published in May, and they had a forecast based on a very optimistic forecast on interest rates, which is based on where the market was at the time prior to the March FOMC meeting. They added 100 basis points to that, and when they added 100 basis points to that, it showed Fed losses. We're now about 150 basis points above where we were in that March meeting. So if we stay on this trajectory, the Fed's definitely going to lose money in calendar year 2023. I mean, it's too soon to say we're going to stay on this trajectory, but if this trajectory is realized, the Fed will lose money. And I think there's sort of two broad implications of this. Number one is the issue of MBS sales. If they're losing money already, they're not going to be selling agency MBS, because every agency MBS they sell they're just going to add to their losses. The Fed doesn't have to mark their securities holdings to market. It doesn't flow through their income statement. They only realize losses when they actually sell securities. So selling agency MBS would be adding to the losses. The second thing I think it's going to do is it's going to lead to a really fearsome debate about quantitative easing, because there's a whole wing of the economics profession, more on the conservative side, that doesn't like quantitative easing in the first place. And if the quantitative easing leads to Fed losses, people are going to use that as a lever to try to restrict the Fed's ability to engage in quantitative easing in the future. They're basically going to say, look, the losses show that the Federal Reserve monetary policy has now moved from monetary policy into fiscal policy. There are fiscal consequences to what the Fed has done. The Fed shouldn't be allowed to do that. If that were to happen, I think that's really dangerous, because you're taking away a very important tool of monetary policy when the Fed's at the zero lower bound. I also think it really ignores two important elements of the story here. It's not whether you're taking losses in a particular year. It's what's the cumulative cost of quantitative easing. And if you look over the last 10 years, it's generated enormous excess returns for the Fed, much greater than what the Fed is likely to lose in 2020, 2023. Also, you have to think about how would the economy perform if you didn't do the quantitative easing. If the economy had been much weaker because you didn't do quantitative easing, the tax revenues to the government would be a lot lower, and that needs to also be factored into the equation. So my concern is not, will the Fed be able to conduct monetary policy if they're losing money? They'll be able to conduct monetary policy fine. The central bank, the Treasury will create a deferred asset so the Federal Reserve doesn't deplete its capital. Monetary policy implementation will not be affected at all. But there could be a big debate about quantitative easing as people who have been opposed to quantitative easing for some time seize on this and argue that, gee, you shouldn't let the Fed have these tools. Look what happened in terms of losing money in 2023 and potentially 2024. So I think it's an important political economy question that could very well come up in 2023. And I was sort of surprised yesterday that nobody asked the chairman about this, because I think it is sort of relevant given the change in the Fed's interest rate projections. Under the old projections, they weren't going to lose money. Under the new projections, that they are going to lose money. So there is been a pretty significant sea change in the implications of their forecasts for the Fed's profitability.
Thank you. That was fantastic. So a bunch of questions coming in. Let me start out with a bigger one. Higher interest rates means higher nominal deficits. Of course, inflation's higher, so that reduces debt GDP. But I think this does raise a broader question about if you believe the U.S. is headed towards a hard landing, what should be the role of fiscal policy alongside the Fed's evolving monetary policy?
Well, debt service costs are going to go up pretty sharply over the next couple of years. I mean, we've been in this amazing period where the amount of government debt outstanding has more than tripled since 2007, 2008. And debt service costs have gone up, very marginally. I think the number on the order of maybe 20% or so. That era is over. As the Fed raises interest rates sharply, that's going to gradually feed into the federal government financing costs. It doesn't happen that quickly because the average maturity of the Treasury debt is about 6 years, so it's going to take some time for that to occur. And in the near term, the debt to GDP ratio is actually coming down because we've had such strong inflation. Nominal GDP has been growing very, very rapidly. So that's going to give us a little bit of room for a while. So I don't think it's going to be an issue in the very near term. But I think over the medium to longer term, yeah, we're going to find out that fiscal policy stimulus does ultimately have a cost. I think that fiscal policy stimulus in economic downturns is completely appropriate. I think that's why you want to have fiscal capacity in reserve. So you always have the ability to do that in an economic downturn. You don't want a situation where people start to worry about fiscal sustainability. I don't think we're anywhere close to that point today, but you look down the road, higher debt service costs, baby boomers retiring, higher costs for Social Security, higher costs for Medicare. I can imagine 5 years from now, the bond market vigilantes may be back. In terms of worrying about fiscal sustainability. And the fiscal sustainability is also important because it'll put more pressure on the Fed, and then there'll be more of a tension. Well, is the Fed willing to do what it needs to do in terms of interest rates, regardless of the fiscal implications of those higher interest rates? What economists talk about is fiscal dominance. Fiscal dominance is when the fiscal indebtedness is so high that the central bank essentially caves and then essentially monetizes the debt. That is not a good place to end up. That leads to not just a little bit of inflation, it leads to a lot of inflation, and hopefully we never get to that point.
So I think I first met you when you were managing the desk. So I have a question about the future of the reverse repo facility and its utilization, and what might that mean for getting it to lower levels and QT more generally?
So the reverse repo facility is basically putting a floor on terms of short-term interest rates and soaking up a lot of cash from like money market mutual funds who otherwise would, rates would be even lower. So it's a way of putting a floor under interest rates. And right now, it's being used to a very large degree. It's about $2 trillion in the reverse repo facility. What the Fed thinks is going to happen as the balance sheet gradually shrinks, the amount of reserves in the system will shrink. And the Fed thinks that this will put very gentle upward pressure on money market rates within the Federal Reserve's federal funds target range. So there's a target range, and within that range, you have repo rates, you have treasury rates, you have a whole bunch of different rates that fall in there. Fed thinks as the balance sheet normalizes, you'll see a little bit of upward pressure on money market rates. And when that happens, the reverse repo facility will become less attractive. As it becomes less attractive, the amount of money going to the reverse repo facility will shrink. So that's how they think it will play out. As the reverse repo facility shrinks, that means there's more reserves in the banking system, and that just extends the period of time where the balance sheet needs to shrink to get the reserves down to the level where the Federal Reserve wants them to go. But what's interesting about the SOMA Managers Report is they really outline exactly how they're going to do this in much more detail than we've seen before. They basically said that in December 2019, reserves in the banking system were 8% of GDP, and they basically implied that that was a good benchmark. That's sort of where they're headed. And they basically said when we get to 10% of GDP, since we don't know exactly the amount of bank demand for reserves, we're going to then start to reduce the rate of runoff in our balance sheet. So at 10% of reserves of GDP, we're going to start to reduce the rate of runoff of our balance sheet. Then when we get to 9% reserves to GDP ratio, we're going to stop runoff altogether. We're just going to reinvest what's all coming due. And we're just going to wait for the economy to grow and currency outstanding to increase to push the ratio down to 8%. So very much a tapering kind of approach. Last time we just crashed through the desired level of reserves, and that's what led to the spike in repo rates in September 2019. The Federal Reserve is determined not for that to happen this time. So they're going to approach their idea of what's the desired level very, very, they're going to go here, and then the desired level is going to increase. So very cautious on this. I think the chances of a crack up like we had in September 2019 is very low, both because of the Fed's care, but also because we now have a repo facility, a standing repo facility that's just a little bit above market prices that's available to people to go if they're actually short of reserves. We didn't have an automatic reserve replenishment mechanism last time. Now, if there's a shortage of reserves, banks can go and get reserves at a very low excess cost. So I think that kind of crack up September 2019, I think the risk of that happening again is famous last word, is very low.
Two separate questions came in on the same theme. Basically, monetary policy works with the lag. One person says, well, is that a guarantee they'll over tighten and cause a recession? Another person says, doesn't the Fed's data dependency, given lags in monetary policy, increase the risk of being behind the curve?
I mean, I think both those questions, answer themselves. Yes, to the extent that the Fed, is not going to relent until they see meaningful improvement in actual inflation. By the time they realize they've done enough, it's possible that they'll have done too much. So I think that's true. That said, the fact that monetary policy now operates through forward guidance, and that forward guidance gets incorporated in financial conditions pretty instantaneously, means that the lags of monetary policy are probably less long than they were when the Fed was operating monetary policy essentially in secret, without forward guidance, without talking to the markets. So we've seen the stock market go down a lot, even though the federal funds rate is still below neutral. So that's essentially telling you that the market's reacting to not what the federal funds rate is today, but what they expect the federal funds rate to be, a year from now. So that means that reduces the lags of monetary policy in terms of its effects on the economy. I think the danger is more about the Fed recognizing from the data that they've done enough to accomplish their mission. They're going to see a slowing of inflation, but the question is, how much of a slowing do they need to see, and to what level do they need to see it? How much of a rise in the unemployment rate do they need to see? To what level? We don't even know for sure what NAIRU is. What the full employment rate is. If you take a look at the level of unfilled jobs relative to unemployment, it's extraordinarily elevated, as Chair Powell talked about yesterday. That argues that potentially full employment, the unemployment rate consistent with 2% inflation, isn't 4%. It runs the risk that it's actually higher than that. Last cycle, we were surprised that it turned out we could drive the economy to a higher level of labor utilization without inflation than we thought. If you look at where the Fed's forecast of full employment was last cycle, they kept coming down. There is a risk this time that 4% is too low. And if that's the case, that would also reinforce the idea that the Federal Reserve could be late this cycle. I think this is why it's really hard to generate a soft landing. Chair Powell cited 3 episodes of soft landing a number of months ago, 65, 66, 84, 85, and 93 to 95. All 3 of those episodes were episodes where the Fed tightened and the economy didn't go into recession, but the unemployment rate never rose in any of those tightening cycles. This time, the Fed is telling us something very different. They need to push the unemployment rate up. They've never pulled off a soft landing in that kind of situation in the post-World War II period. Now, you could argue we haven't had that many business cycles since World War II, but it is striking to me that there have been no examples of the unemployment rate rising between 0.5% and 2 percentage points in the post-World War period. It's either trivial or it's a lot. And that's really why I'm of the view that if you believe that the Federal Reserve has to push the unemployment rate up by 0.5 percentage point or more, then a hard landing is almost, it's almost virtually inevitable.
Well, I think you've answered one viewer's question, which was, do we need forward guidance? Balance sheet, back to that, how do you think about the stock of the balance sheet versus the flow? And since I was debating this with Joe Gagnon the other day, are QE and QT symmetrical?
Well, we don't have, as you know, we don't have a lot of experience with either QE or QT. And so, I think, the Federal Reserve is still learning. If you look at the estimates of, what's QT equivalent to in terms of short-term interest rates, I think, the range was like 0.3 to 0.9. So it was a pretty broad range. So that's partly why the Federal Reserve relies on the federal funds rate as its primary tool of monetary policy, because it doesn't really know how powerful QT actually is going to be. I think the stock is, more important than the flow, in my own opinion, because the stock basically determines how much securities have to be absorbed by the private sector. And the stock also determines how much excess deposits and reserves there sits in the banking system. My view is that quantitative easing works through a number of channels. One channel is by just removing long duration assets from the market. That makes those assets scarce. And so private investors are forced to bid up the price of the assets that have been bid away from them. But the second channel by which quantitative easing works is it creates a lot of excess deposits in the banking system, deposits that people don't really want. And when we're at the zero lower bound for interest rates, those deposits are particularly unattractive because they're earning nothing. And so people try to get out of the deposits by going out and buying securities with positive yields. When they do that, they just create a deposit for the person that they bought the security from. So there's a bit of hot potatoes. Everyone's trying to get out of the deposit to earn a positive return. And so I think that's the other the way that quantitative easing works. So I think the stock is probably more important than the flow. But if you said you're going to reduce the stock by $1 a year over the next trillion years, then obviously the flow would be pretty meaningful to people in the marketplace. So it's never not one or the other. But I think if you're reducing the excess reserves at a relatively fast rate, I don't think it really matters that much if it takes 3 years to get back to a normal balance sheet or 4 years to get back to a normal balance sheet. If you told me it was 1 billion years, then of course then the flow matters.
All right. Well, I have 2 more questions. I think we have about 7 minutes before we need to liberate you. One is, let's deal with it briefly, but as a Treasury person, I've watched for decades how the Fed thinks about international developments, how that factors into its reaction function. I think the Fed has a dual mandate. It takes care of the U.S. economy. If foreign events affect it, okay. They take that into account. That role has probably grown over time as financial channels have. Dollar's very strong now. A lot of worries about emerging market crises from Fed tightening. Do you think any of this is factoring into their thinking?
Well, I think they're certainly aware of it, and I'm sure they're talking about it. I mean, I think it's a really serious risk. This is why the Bretton Woods Committee has been spending so much time on sovereign debt issues and sovereign debt restructuring issues, transparency issues, because we really do think that we're for a very, very stressful period for low and low income countries over the next 12 to 18 months. So I think they take that on board in terms of thinking about what's the optimal monetary policy. But as you say, at the end of the day, they conduct monetary policy in terms of what's best for them to achieve their objectives for the United States. 2% inflation at the maximum sustainable unemployment rate. I'd like to turn to Ellen and give her a chance to maybe respond to some of these questions. It seems a little unfair. So Ellen, if you'd like to respond to some of the issues that Mark and the audience has raised, I'd like to get your opinion.
And leave us about 2 or 3 minutes for my last question, Ellen. So go for it.
So I had one thing I just wanted to follow up on the questions around the balance sheet and all the interesting remarks that you made, Bill. Did you think in that SOMA annual report that the notion of returning to the December 2019 reserves as a share of GDP, the 8% number, might be a little optimistic? I mean, I take your point that they don't say we're just going to run down to that and run the risk of creating turbulence. We're going to start to alter our QT at 10%, and then we're going to kind of do this glide path into 8. But in particular, I'm thinking about some of the things I've read that Bill Nelson at the Bank Policy Institute has written about speaking with bank treasurers and CFOs about there being some hysteresis in reserve balance preferences for holding reserve balances. And with the Fed's increasing QE, they raise their desired holdings of reserve balances. Is that 8% too low? I mean, and do you think that the plan allows for enough wiggle room so that the Fed doesn't hit the September 2019 problem again?
So I think that's why they're starting to change their policy at 10% of GDP. So that's 25% above the 8% number. So that gives them a little bit of margin. But I think to your point, they don't really know. I mean, everyone was hugely surprised when this happened last time. So I think they're going to be talking to the banks a lot more closely about what is your underlying demand for reserves. At what point are you going to start to get anxious about not having enough reserves in terms of on your balance sheet? So I think they'll have those discussions. I mean, last time what happened though wasn't just the Fed was surprised, the bankers were surprised as well. I think everybody thought that I have enough reserves for me and they have enough reserves for them, and it turned out that just didn't turn out to be true. And what happened last time was once you found out there weren't enough reserves in the system, everyone scrambled to hold more reserves, and that just made the problem worse. So, I think the standing repo facility, will mitigate against that risk. But I think you're right. I mean, this is just sort of a, on paper kind of estimate at this point, and I think they'll basically go to the banks and try to see, is that number change over time? So I think you're absolutely right about that.
Do I have one more minute, Mark, or do I turn it back to you at this point?
Go for it.
So on the SLR, you made the supplementary leverage ratio, you made a couple of comments about that. And I was interested to see that Michael Barr was asked repeatedly in his confirmation hearing, about whether he would take that under consideration. And he talked about looking at all the capital requirements as a package. I'm wondering if you'd like to speculate about how you think the Fed's going to handle that one.
I think it's coming, but it's, as you just noted, it's really politically sensitive. And I think what the Federal Reserve needs to do is do it in a way that doesn't actually reduce capital requirements. I think you can basically exempt reserves from the leverage ratio without reducing capital requirements. And then you go to explain to Elizabeth Warren and others on the Senate Banking Committee that this is not making the bank, we're not being lenient on banks. We're just making the system, making this adjustment to make the system work better. End of the day, reserves don't have risk. They don't have risk. And so requiring capital against reserves, it doesn't really accomplish very much. And it can create, make monetary policy at odds with the capital requirements. if the Fed's engaging in quantitative easing, they're adding a lot of reserves to the banking system. If they're adding a lot of reserves to the banking system, that can make the leverage ratio more binding. If the leverage ratio is more binding, then that's actually constraining banks' ability to lend. That's not really what you want. You don't want to have those working at cross purposes to one another. So I'm hopeful that this is coming. I wanted this to happen many years ago. I lost the argument at the time. So I'm not going to give up because it just doesn't make sense, the current setup. But we need to explain to people who think that this is a handout to banks, that doesn't have to be a handout to banks. We can do this in a way that's not reducing capital requirements to the banking system, not making the banking system less safe. And so we need to do that as part of that process. But I think that's eminently achievable.
Okay, I'm going to do what I said I wouldn't do and just keep you here for 2 more minutes beyond 11 o'clock. But the questions have come in about credibility of the Fed. There have been numerous press reports before the FOMC. The Fed's lost trust. The Fed isn't credible. My view is, well, even if they were late to the party or taking away the punch bowl in this case, there were a lot of exogenous factors: Russia, Ukraine, commodities. They're dealing with pandemics, supply chains, lockdowns, a lot of unprecedented things. And one should be a little more sensitive to the plight that the Fed staff and the Fed governors found themselves in, and not bandy about the idea that the Fed, which is a wonderful place, has lost credibility. But how do you see it, Bill?
Well, I think it's, my view is that, clearly they were late to remove monetary policy accommodation. Just think about it. Early March, they were still adding accommodation in March. And now look at where the forecast is, just a little bit over 3 months later. So that's a pretty big sea change in terms of the Fed's thinking. And you're right, they've also been unlucky. So I think partly was how they executed their framework. They basically tied their hands and said, we can't do anything until we've achieved these conditions of 2% inflation and full employment. So that turned out to be a mistake. But they were also unlucky. The supply chain disruptions turned out to be much bigger, much more severe, and lasted much longer time. The good news is that they haven't lost credibility to any great degree, and you can see that in terms of the fact that inflation expectations are still pretty well anchored. They're not perfectly anchored, but they're pretty well anchored, even though the Fed has been very slow to tighten, and CPI inflation is over 8%. It's pretty remarkable, frankly. If you told me that inflation was going to be over 8%, and the Federal Reserve hadn't started to tighten until March of this year, I would have thought the Fed would have had lost much more credibility than it has. So I think Chair Powell has done a good job of talking about Paul Volcker. I think he's done a good job of talking about how you don't want to let inflation expectations get unanchored. I think he's convinced people that he means it. And the forecast now is starting to reflect that. The forecast in December and March, I don't think really reflected that. But now I think they're getting to a forecast that actually shows, monetary policy moving to restrictive. The chair has talked about monetary policy now moving to restrictive. And so, now they just have to do what they say they're planning to do. And I think, they will achieve their objective in terms of getting inflation back down. I think the big issue for me is just it's probably going to turn out to be considerably more painful than what they're showing in their median forecast.
Great words to end on, a good synopsis of your views. Tremendous thanks to Bill Dudley and Ellen Mead for joining us today for this joint Bretton Woods Committee OMFIF presentation. Have a good day, everybody. Thanks again, Bill and Ellen.
Thank you both.
Thanks.